Hi there, this is Hugo. Imagine building a digital network so essential that 80% of all doctors in the United States log on to it. Now imagine Wall Street throwing a tantrum and selling the stock because that network cannot grow infinitely forever. Today, I want to show you why that panic is our opportunity. So, what exactly is Doximity? Think of it as the digital town square for American medicine. Doctors do not pay to show up. Instead, they use the platform to collaborate with colleagues, read the latest medical research, manage their on-call schedules, and conduct virtual telehealth visits with patients. Here is why this business caught my eye. It is an incredibly asset-light toll bridge. Once you have a captive audience of doctors, pharmaceutical companies have absolutely no substitute if they want to run targeted digital campaigns. Right now, the stock is being temporarily punished because of some macro budget freezes, giving us a rare window to look under the hood of this compounding machine. Let's talk about how they actually fill the cash register. An overwhelming 95% of their revenue comes from recurring subscription revenue. They charge pharmaceutical manufacturers and health systems for digital marketing, telehealth, and workflow solutions. They also have a hidden reservoir of future value with their new AI clinical reference tool, DocsGPT, which is already used by over 300,000 unique prescribers, even though management hasn't fully monetized it yet. The competitive angle here is all about owning the professional mindshare. Doximity has captured over 80% of all U.S. physicians and 2/3 of all nurse practitioners and physician assistants. Once a client integrates Doximity into their marketing budget, they tend to stay and spend more, which we can clearly see in their 112% net revenue retention rate. Looking at the key stats, this is a highly profitable mid-cap. The market cap sits at $4.27 billion. They have 188.88 million diluted shares outstanding, and they operate squarely in the healthcare sector. Charlie Munger always said to look at the downside first, so let's walk through the storm clouds on the horizon. First, there is the reality of market saturation in the US. Second, slowing revenue growth tied to frozen pharmaceutical budgets. Third, emerging AI competitors trying to build a ChatGPT for doctors. And finally, the uncertainty around their international expansion. Right now, Wall Street is hyperventilating because the company's future revenue guidance dropped to roughly 10%. A lot of this pessimism stems from pharmaceutical clients delaying their advertising budgets because they were waiting for the ink to dry on White House most favored nation drug pricing deals. Wall Street hates uncertainty, so the stock sold off hard on what looks like a cyclical pause. But here is what the panic sellers are missing. Yes, the market saturation is real, but we aren't pricing this like a hyper-growth software startup. We are treating it like a mature farm with a conservative 2.5% terminal growth rate. As for the pharma budgets, it's a temporary pause. In fact, their January pharma bookings hit record highs. The threat of AI startups is overblown because doctors demand trust over hype, and Doximity has 10,000 medical experts verifying their AI outputs. Finally, they don't need international expansion to win. They generate massive free cash flow simply by dominating their home turf. Let's strip away the accounting fiction and look at the real cash this business generates. We begin with the cash this business actually collected, which is $315.42 million in operating cash flow. Next, we have to subtract $102.95 million in stock-based compensation because management is giving away slices of our pie, and that is a real expense. Then, we adjust for working capital movements by factoring in a negative $31.51 million for working capital change and subtracting $3.48 million for working capital reinvestment. Finally, we subtract $9.12 million for maintenance capex, which is based on their historical 5-year average, because they don't need to spend much to keep the lights on. After all the real costs, this business put $231.38 million in our pocket as owner earnings. To figure out what that means for us as individual investors, we take that $231.38 million in owner earnings and divide it by their 188.88 million shares outstanding. That leaves us with a clean, normalized owner earnings per share of $1.23, A great business needs a moat to protect its profits, and Doximity's moat is built on profound pricing power. They boast a phenomenal return on invested capital of 23.59%, and their competitive trajectory is strengthening. Now, they do have named competitors like Viva Systems, Teladoc Health, IQVIA Holdings, and the startup Open Evidence. But here is the structural difference. While Teladoc focuses heavily on patient-facing virtual care expansions and Open Evidence lacks medical distribution, Doximity actually owns the underlying physician directory and social network. You cannot easily displace a platform that owns the daily attention of doctors. When you look in the rearview mirror, this business has been an absolute compounding machine. Over the last 5 years, their owner earnings grew at a staggering 54.40% compound annual growth rate. We can see the underlying strength in their 5-year revenue trend, which grew monotonically from $343.55 million to $637.78 million. And if their moat was eroding, margins would shrink. But their 5-year operating margin trend actually expanded from 33.05% to 38.46%, alongside an incredible 89.75% gross margin. Let's check the floorboards and look at the balance sheet. It is absolutely pristine. They have $735.13 million in liquid assets and virtually zero debt, sitting at just $10.69 million. That gives them a fortress-like net cash total of $724.44 million to weather any macro storms. How does management react when their high-return stock drops? Bad managers buy other companies to hide slowing growth. These guys are acting like true owners. They recently authorized a massive $500 million open-ended share repurchase program. They are aggressively cannibalizing the share count at cheap prices rather than chasing foolish acquisitions. Before we calculate a price, I always run the business through my 4-pillar test. First, do we understand it? Yes. It's a digital toll bridge selling marketing access to a captive medical audience. Second, are the economics durable? Yes, it is incredibly asset-light, requiring a microscopic 1.43% of revenue for maintenance capex over the last 5 years. Third, is management honest and capable? Yes. They are incredibly disciplined, hoarding cash and cannibalizing their own float with massive $500 million buybacks instead of making dumb acquisitions. And fourth, is it an attractive price? Yes. The market has discounted it heavily due to temporary regulatory noise. Now for the math, we start with our owner earnings per share of $1.23. Because this is a mature, high-return franchise with a dominant moat, I'm assigning it a fair multiple of 20 times earnings. Next, because management actively uses their excess capital for our benefit, we add back their net cash total per share, which is $3.84. We multiply $1.23 by 20, add the $3.84 in cash, and we arrive at an intrinsic value of $28.44 per share. We never want to pay full price, no matter how good the business is. Right now, the market is offering us shares at a current price of $24. Compared to our intrinsic value of $28.44, that gives us a margin of safety of 15.6%. My honest verdict is that this is a genuine value opportunity. Wall Street is completely overreacting to temporary headwinds and delayed pharma budgets. A business does not post nearly 90% gross margins if its moat is broken. You are being offered the chance to buy an asset-light monopoly over the U.S. physician market at a discount, right alongside a management team that is using its fortress balance sheet to buy back $500 million of the company. Thanks so much for walking through the numbers with me today. Remember, I'm just sharing my own research process here. Always dig into the financials and do your own homework before buying any business. If you enjoyed this breakdown, make sure to subscribe for more deep value analysis. Stay rational out there, and I will see you in the next one.